Hi, my name is John Cobb. I'm Director of Trinity Wealth Management, and today I'm going to be talking about lump sum investments, and my colleague's going to be asking me some of the questions that I'm regularly asked on this subject.
Well, I think the great way to start off would be to tell us how the whole process begins when you have a new client approach the company.
Yeah, even if a client came with the intention of just investing a lump sum, we have to go back to financial planning before we look at investment management. And this is because investment management is typically a solution to a problem, a solution to the achievement of a goal. Therefore, we need to find out what the client's goals and aims are, and then apply investment management to be able to solve those solutions. It may be retirement planning, saving for education fees, those kinds of things. So that's the point where it starts. Along with that, that will give us an idea of the growth rate that is required to be able to achieve that goal. Because ideally what we want to do is achieve that goal with the minimal risk being taken. If a goal can be achieved from a 4% return, why do we need to take additional risk aiming for a 7 or 8% return?
Looking at how you actually manage a client's investments, would you say that you're a discretionary fund manager?
No, not at all. Although I'm qualified to provide discretionary advice, we've just decided that the advisory process is better served that I tell the client what I want to do and get their agreement. Now, we don't take very short-term bets. So the fact that the process involves me saying, I'd like to move from this fund to this fund, and I need your, whether it be an email, telephone, it is not so much of a problem. But I think it, again, controls risk rather than me saying, this is what I've done. So yeah, no, we're advisory.
When a client has agreed to make an investment with Trinity, with yourself, what would you say is the first stage of that investment process?
Yeah, this is a good thing. I think a word that we'll hear time and time again, which is critical to investment management, is risk tolerance. And it's worth taking time to ascertain properly the risk that that client is prepared to take. Now, I remember in the good old days where we would quite literally go along to a client with 5 definitions of risk ranging from low to high, and we'd say, which one of these are you? And they'd typically go medium, which really meant, I don't know what my risk is. But things are far more scientific now, and the whole methodology of ascertaining a client's risk is far more sophisticated. And we use probably one of the most highly renowned and regarded risk management, risk assessment tools that is out there that will allow you to determine your risk versus the average of thousands and thousands of other investors. And then what we do is that we then apply that level of risk to a particular asset allocation model.
Asset allocation, can you expand on that?
Yeah, certainly. Again, going back to risk, what's really important is to achieve the goal with a minimal risk. Now isn't the time to get into such things as what they call efficient frontier or any of those more scientific sides of investment management. But basically, if we can diversify a portfolio, investing in different types of assets that move in different directions at different times, we can lower the risk while still achieving the same levels of return. That's effectively what asset allocation does. Now, most advisors out there still use the traditional asset allocation models, which is equities, fixed interest, and maybe a little bit of property. I feel that's something of an abrogation of responsibility. The retail market now is far broader, and what we have is access to a much broader range of asset classes. Commodities, hedge funds to name two. I'm not necessarily saying that they may be part of a client's portfolio, but I feel that the advisor should have some understanding of those asset classes. So what we effectively do is, based on your risk, is we will blend a portfolio with a mixture of these different asset classes that are available.
We hear a lot of different arguments these days regarding active versus passive fund management. What would you say that your view is in this area?
Yes, I have some quite strong views on that, I must admit. If you'd have spoken to me 2-3 years ago, I would have said that I was a dyed-in-the-wool active fund manager. I really believe that story. I think there is sufficient empirical evidence to suggest that active fund management does not provide added value. The terminology that we use is we're looking for alpha, which is effectively the fund management skill that will provide you an additional return over and above what the market will do. But I'd contend that the market, say the stock market, say the FTSE 100, has value in it anyway. If you look at statistics, you'll see that over a reasonable time period, the FTSE will grow. So why take the additional risk of a fund manager making a decision to reduce his exposure in BP, increase his exposure in Vodafone, to try and beat the market? The analogy that I use is a game of tennis. Now, typically, and if you played tennis with me, you'd probably beat me. The reason would be not because of your forearm smash or your brilliant serves. It's because I would be hitting it in the net or hitting it beyond the line. It would be my mistakes that would make you win the game of tennis. And I think it's the same in fund management. Yeah, you know, they could make some calls that are good calls, but over a period of time, the chances are they will make more mistakes than they will good calls, and therefore, you know, the return is going to be compromised. When you add on top of that the charges, the additional charges that you're paying for that active fund management, it's a very difficult argument to stick with active fund management. I mean, it's funny really, Adam. I was looking, take for example, all funds that invest, UK domicile funds that invest in the FTSE All Share. Over 12 months to the end of this last year, 119 out of 323 did beat the All Share. That's pretty good. So roughly about a third. But we're not going to be in the market just for 12 months. We need to look at longer term data. If you take, for example, 5 years to the end of 2009, only 64 of the funds out of 232 funds actually beat the index. Now, if you add in the charges as well, the number reduces even further. So the chance of your advisor picking one of those 64, you know, it's pretty remote. I'd suggest to you, why take the risk? The other thing that's worth bearing in mind is that in a lot of studies as to whether it's fund management or asset allocation that provides the outperformance. And again, much of these studies prove that 90% of the return actually comes from correct asset allocation rather than fund selection. So if fund selection is only going to equal 10% of the return, why make all the effort in trying to choose the correct fund? That's not what we do at Trinity.
So once a client's money's been invested, do they ever hear from you again?
Good question. At Trinity, this is all about being relational. At the end of the day, goals change. At the end of the day, investments change. Different asset classes come available, etc., etc. And what is really important is that we want our clients to understand that this is relational. We're not on the other side of the fence. We're walking with the client until they achieve their goal. We're walking with them. We will see you at least once a year to go through your portfolio, to go through your goals. This is all about a relationship. We don't want just to see you once and then you never see us again.